Come on, friends. Today, let's explore the top 3 sovereign wealth funds globally. In the last episode, we discussed the top 10 global sovereign wealth funds, 6 Middle Eastern, which earned them the title tycoons. Today, we will reveal an even more significant part, the top 3, and of course, number 7. I can confirm the United States is not included. We'll discuss it separately later. Now let's examine the world's 7th largest sovereign wealth fund. Singapore's GIC manages around $801 billion in assets. Hong Kong and Singapore are like close brothers with very similar economic models. How can Hong Kong exist without Singapore? Don't be misled by GIC's 7th rank. It has 2 other funds, making 3. Today we'll discuss 3 funds poised to join the trillion-dollar club, starting with Temasek Holdings' $288 billion assets. Globally, it ranks around 12th or 13th, while the Monetary Authority of Singapore fund amounts to approximately $620 billion. It may rank among the top 10, but people don't consider it a sovereign wealth fund. Where does Singapore's government get its funds? Its logic is similar to Hong Kong's. As an Asian port and financial center, it maintains surpluses in the current and capital accounts, making it profitable while others keep investing in it. Singapore is more robust and profitable than Hong Kong, which primarily earns through services and continues to experience a trade deficit. Singapore's industrial and manufacturing sectors make its trade positive, profitable, and highly lucrative. Consider Hong Kong with a 5-10% GDP current account surplus, which is high. In contrast, Singapore hasn't fallen below 15% recently and was even higher before 2008. At one point close to 30%, it made massive profits in global trade, naturally accumulating wealth as Singapore's central bank foreign exchange reserves. Hong Kong pools most foreign exchange reserves into a fund and subsequently splits them internally into diverse investment portfolios. Singapore, however, differs by retaining some in the Central Monetary Authority and allocating a large portion to establish 2 separate funds, GIC and Temasek. MAS's central bank fund serves as a foreign exchange reserve to regulate the Singapore dollar's exchange rate stability. For instance, in 2022, when the US was particularly strong and global capital flowed back, the dollar surged, yet the Singapore dollar didn't depreciate as much. Why? All this cost? See Singapore's MAS then? Spent a third of its reserves to maintain the stability of its exchange rate, using dollars to support the Singapore dollar. It's a bit like a defensive player in a team. Such an important matter, his investments are also very conservative, with basically 90% in bonds. From a scale perspective, this GIC belongs to the main force, like the midfield core of a team, so its investment style is professional and methodical step-by-step approach, emphasizing diversification to avoid losses. I don't pursue alpha or excess returns. It truly follows what's taught in textbooks. I'll lay it out for you. Let's study it. Its allocation is roughly 1/3 each to bonds, stocks, real estate, and private equity, geographically spread globally, possibly with a slightly higher allocation in Asia. Various combination strategies we won't elaborate on. If you're interested in investing, our channel's viewers with hidden talents and have several hundred million but don't know how to invest, my suggestion is review the professional investment reports released by GIC. You don't need to replicate their investments, but they offer a valuable template and foundation. Moreover, I think this report is at least very honest, giving you information and data, unlike the Middle East, which is also tricky. GIC's real investment returns over the past 20 years are the returns after excluding inflation rates. A 3.9% return is slightly low among these sovereign funds, likely due to their US stock allocation, similar to many Middle Eastern funds. The last one, Maxi Holdings, has a more aggressive investment style, like a shadow forward in a team, quick in and out, very agile, unlike debt. All of these are equity investments, and more than half involve higher risk private equity or even certain startup ventures. The agile investment style may explain its smaller scale but higher exposure. Additionally, the name Dan Maxi could be more familiar to the public than the other 2 firms. So you see MAS, GIC, Dimasi's Defense Factory, and Forwards cooperate to form Singapore's financial community team. Then, half of the profits earned by these 3 funds are given to the Singapore government. The interest income from these funds already accounts for 1/5 of the government's revenue. It is the government's largest income source, surpassing corporate and personal taxes. Half the profits are kept in funds to snowball. Half goes to government and half to snowballing, Singapore's unique NIR mechanism. subtitled by Jonathan Lee. Next, we will reveal the top 3 sovereign wealth funds in the world. China Huijin Investment Co. Limited takes 3rd place, managing assets of $109 trillion, our first trillion-dollar fund. Hoan Investment is a subsidiary of SAFE, an agency under China's central bank managing foreign exchange reserves. To be honest, I see Huan listed in all rankings of sovereign foreign exchange funds, but its public information is extremely limited and overall very mysterious. It operates under the State Administration of Foreign Exchange. The Foreign Exchange Business Center's overseas section includes 5 companies: Huaxin, Huan, Huaou, Huamei. The 4 Golden Flowers and Frankfurt Trading Room are overseas institutions of the State Administration of Foreign Exchange, investing foreign reserves globally. Each investment direction has a unique focus, evident from their names. Huamei invests in the US, Huaou in Europe, Huaxin in Asia, Singapore, and Huan, established in Hong Kong in 1997, invests globally. Under the State Administration of Foreign Exchange, aside from the 4 Golden Flowers, many other elegant institutions exist, such as Wutong Tree, Ginkgo Tree, and Mandala. The private funds established for the Belt and Road Initiative are institutions under the State Administration of Foreign Exchange, collectively known as the SAFE system. The SAFE system is funded by China's foreign exchange reserves, approximately 3.2 trillion dais, 2,000 tons of gold, and special derivative rights. Japan is second, nearly 3 times smaller, holding over a quarter of reserves. If pooled together, these funds would form the world's largest. However, the State Administration of Foreign Exchange doesn't. Approximately 55% of assets are in USD, exceeding half. Recently, the State Administration has been intentionally reducing USD investments, especially US Treasury bonds. More than 15 years ago, SAFE at one held over. US Treasury bonds decreased from $1.2 trillion to $750 billion. In contrast, Japan holds $1.25 trillion in reserves, with over $1 trillion invested in US Treasuries. The US government is the largest global creditor. The Bank of Japan might have it easier, as their reserves are all in US Treasury bonds. Now let's examine the world's second largest sovereign wealth fund. China Investment Corporation, CIC, manages total assets of about $1.33 trillion. Notably, even Syria is involved in China's sovereign fund. They clearly represent the 2 main sovereign fund components. These are the SAFE and CIC groups. We can say little about SAFE due to limited mysterious data, but there is information available on the CIC group. So let's take a look at it. First, the funding source of CIC. In 2007, it issued 1.55 trillion in special bonds. It bought 200 Bali's foreign reserves from the central bank to set up the fund company and raised capital by 409 to 1, which is confusing. Theoretically uses the central bank's foreign exchange reserves directly, but was established through Ministry of Finance bond issuance with assets exceeding 1 trillion. It's not part of China's 3.57 trillion yuan foreign exchange reserves. The State Administration of Foreign Exchange operates under the central bank. Meanwhile, the Ministry of Finance manages the public referendum as a central state-owned enterprise and a ministerial-level state investment entity. China has approximately 100 entities, but only 3, China Railway, CITIC Group, and Central Huijin, are at the ministerial level, illustrating their status. Dongtu founded in 2007 for independent investment. The company has 3 distinct subsidiaries: China Investment Overseas, China Investment Capital, and Central Huijin. First 2 primarily invest overseas, while Central Huijin targets the domestic market as the largest and most formidable part. Let's discuss Central Huijin. In mainland China's A-share market, you might often hear the concept of the national team. The term national team, as in has entered the market or is acting, typically refers to fund entities with a national background, such as they have various subsidiaries with unique names like the China Securities Finance Corporation. Central Huijin under the State Council is a key elite unit within the team. Several larger state-owned financial firms are owned by Huijin. Here are some examples. Central Huijin holds 64% of Bank of China, 57% of China Construction Bank, 40% of CICC, and also China Development Bank. Agricultural Bank of China, ICBC, Everbright, New China Life are party-controlled. The 2024 first half report shows total assets of RMB 7.76 trillion, over 1 trillion USD, indicating China investment mainly holds assets with Central Huijin. Historically, Central Huijin has acted as the national team to stabilize the A-share market during crashes, highlighting its ministerial importance. Mainly because its shares are the country's financial lifelines and everyone's wallets, not just its large funds and money. A major event recently involved Central Huijin. On February 14th, Zhengjin Company acted instead. They announced converting two-thirds of their shares to Central Huijin. On the same day, major asset managers Cinda and Oriental Great Wall, the AMC company everyone usually refers to, has also converted over half its shares to Central Huijin. What does conversion mean? Simply put, it means no buying, selling, or swapping, just a gift. Consequently, Central Huijin's equity holdings now include hundreds more listed companies. State expands brokerage shares as response to structural changes. Asset management firms and China Securities Finance Corp are directly controlled by Ministry of Finance. They have merged under Huijin, which besides banks holds major shares in brokerages. Managed by finance under Zhongtu, Huijin is state-controlled within the state-controlled Mingpao Canada Manga. We initially mentioned Zhongtao's 1.3 trillion yuan scale, not including this equity transfer, a gift potentially boosting China investment by several $100 billion. And look at the timing. They chose February 14th to give it away for free, which is quite romantic, haha. Central Huijin is the main component of China Investment, functioning as a holding company or policy bank. Its other two subsidiaries include China Investment Overseas. China Investment Capital resembles typical investment companies, engaging in asset allocation by purchasing bonds, stocks, real estate, etc. Founded in 2007, China Investment initially struggled with overseas investments, despite immediate investments in firms like Blackstone and Morgan Stanley. These overseas financial companies were hit by the financial crisis, resulting in significant losses and considerable criticism, but they are now recovering. From 2014 to 2023, the overseas investment return rate reached 6.57%. Currently, its asset allocation is roughly as follows: 1/3 in stocks, 16% in bonds, and 48% in alternative assets, nearly half in alternatives, demonstrating its very alternative nature. He defines alternative assets as private equity, hedge funds, real estate, infrastructure, etc. In brief, these investments have higher risks and lower liquidity. His investment in illiquid assets mirrors our analysis of Middle Eastern funds. Privacy protection is likely the main reason. It's rumored hundreds of billions were spent on Belt and Road projects. Recent years show scattered investments by China Investment Corporation. For example, acquiring a Russian fertilizer company and buying a New York building. Among his numerous investments in entities, there's little to elaborate. One caught my attention. I'm telling you, while researching this article, it was the 4th or 5th time I came across it. Do you know which company it is? It's British Heathrow Airport. This is a puzzling discovery. Sovereign wealth funds prefer investing in Heathrow. Look at its shareholders. Funds include Saudi PIF, Qatar Investment Authority, Singapore GIC, China Investment Corporation, Canada's CDPQ, and Australia's pension fund. Various international funds are allocated shares, and I must tell you, they just bought in Dubai. Abu Dhabi is showing interest. Recent rumors suggest its fund may actively purchase shares. I feel Heathrow Airport might hold a shareholders meeting someday to plot something. To manipulate global financial markets, isn't that amazing? What magic does this airport have that makes sovereign wealth funds around the world so obsessed with it? This Heathrow Airport is indeed one of the busiest airports in the world, but that doesn't at all explain why everyone uniquely likes. Looking purely from a financial investment perspective, Heathrow Airport is like most of the world. With a net income of $500 million in 23 and factors like the pandemic and economic crises affecting profits, fluctuating revenue keeps its valuation low. From a financial standpoint, a $10 billion investment isn't great. Its high demand likely arises from its rarity. Its equity may be sold publicly to other countries and their sovereign funds. Most major airports are owned by the country's own government, state-owned enterprises, or at least domestic companies. Seeing that they are putting Heathrow up for sale, it's not expensive anyway, so I have to quickly buy it. Examine the equity structure diagram. It's like an evenly distributed pizza slice. All right, next we're going to announce the world's largest sovereign wealth fund. Norway's government global pension fund manages assets exceeding $1.8 trillion. You know, Norway, a Nordic country, only has a population of 5.5 million. How did it amass wealth equal to 360% of GDP? By oil and natural gas. Norway discovered oil in the North Sea in 1969, leading European production to reach around 3 million barrels daily by 2000, though volumes lagged Middle Eastern nations. It has slightly decreased, yet remains near 2 million barrels daily. Natural gas reserves abundant. Natural gas revenues have also started to surge and now have even surpassed oil revenues. The total annual energy income exceeds $100 billion, so don't be misled by its name, although it's called The pension fund is similar to oil-rich Middle Eastern sovereign funds, mainly funded by fossil fuels instead of typical pension contributions. Funny or not. A wealth fund accumulated from fossil fuels is named the pension fund, which is like having a puppy at home and naming it Kitty. The key is, this isn't an ordinary kitty. This is the biggest dog in the world. All jokes aside, let's get back to Norway's pension fund. One interesting aspect is that its ownership is different from other funds on our list. It's owned neither by the government nor the central bank, but by the Norwegian people. Norway's central bank, Norges Bank, employs fewer than 1,000. They are responsible for managing and investing the fund, minimizing its political aspects. The Norwegian government helps people hold it, ensuring funds aren't misappropriated. All decisions require Parliament's approval. Simply put, the fund is owned by Norwegians, held by the government on their behalf, and managed by Norges Bank. Norway withdraws approximately 3% annually from the fund for fiscal expenditures, representing about 20% of its yearly spending primarily on welfare. This is why people say Norway has excellent social welfare, with most healthcare and education free, and parents receive a full year of paid maternity leave. You could say that the impressive social welfare system is largely thanks to this sovereign fund. Specifically regarding its investment and management style, I think its biggest feature is transparency, extreme transparency. This differs from the Middle Eastern sovereign funds mentioned earlier, yet aligns with their traits. People's ownership ensures transparency, enabling supervision and information access. The official website prominently displays the real-time total market value, which refreshes 13 times per second, according to the CEO. I don't know why they refresh it so frequently. They offer diverse investment statistics, analyses, and original data, all organized into neat tables that are freely downloadable. They fully disclose their investments, detailing companies, categories, amounts, and valuations. Additionally, they only invest in publicly listed firms, avoiding private equity. Because private equity is opaque and prone to corruption, Norway's parliament prohibits investing in it. The Nordic countries are truly transparent, specifying what information must be disclosed, even if you think certain details need not be revealed. It has completely divested. Did we discuss a recent Danish Lego episode? I feel their non-public annual reports are better than those of listed companies. Let's briefly explore its investments, which are divided into 4 major categories: stocks, bonds, real estate, and new energy infrastructure. Heavily promoted recently, new energy infrastructure investment remains minimal, valued at around $2 billion and only 0.1% of total assets, so it can be ignored. Real estate projects total $28.8 billion to 1.8%, much smaller than other sovereign funds. Bonds comprise 26%. The final major discussion is, that is, the remaining investments are all in stocks. Look, this is the world's largest sovereign fund. This Norwegian fund invests 72% in stocks across more than 8,000 companies. It holds 1.5% of all global stocks in terms of market capitalization. Before 2008, the proportion of stocks was approximately 40%, but in the period after 2008, they have also become nearly the world's largest stock buyers. Specifically, what have they invested in? Overall, it does not hold large stakes in individual companies or interfere with their decisions. Unlike BlackRock, joins boards, it does not. It acts solely as a financial investor, widely diversifying investments, and its performance matches the overall. I have to say it's somewhat like a massive global stock ETF. Of course, we can't buy this ETF, even though they verbally state they aim to achieve alpha and excess returns. However, in practice, this is a typical passive investment approach, with advantages of low management costs and reputational risk. I've laid everything out. If it drops, it's due to a bad market, not my fault. Don't underestimate this. Many of the sovereign wealth funds manage large sums. Managing large funds means excess losses or poor decisions trigger significant public pressure. For instance, Singapore's GIC and China Investment Corporation still face such pressure. This Norwegian fund has had an average annual return of 6.3% from 1998 to now. So as you can see, if you look at expected returns from a long-term investment perspective, I think a range of approximately 4% to 7% is relatively reasonable, so you can have an idea. This is the total investment return. As individual investors, we must allocate part to investment managers, requiring further discounting. In my opinion, this Norwegian fund made a significant decision-making mistake. After extensive research, I found they don't own Sydney Airport. Finally, let's talk about the United States. You see, when Trump gave his speech last September, he said he wanted to establish the greatest sovereign wealth fund, and we'll have the greatest sovereign wealth fund of them all. And we should have. On February 3rd, Trump signed an executive order establishing a U.S. sovereign wealth fund upon taking office, a rare and notable project. Trump and Biden both expressed willingness to support it. Firstly, why is the U.S. establishing a sovereign wealth fund? Honestly, if managed well, it provides significant benefits to both the government and the people. Singapore and Norway tax only a small portion of fund returns, becoming major government revenue sources. This enables increased public welfare and tax reductions. Secondly, funds such as Hong Kong's exchange fund, China's foreign exchange funds, and Dongtao's Huijin help maintain economic stability. They maintain exchange rate and domestic financial market stability while investing overseas with the most tangible and direct financial investments. To influence global markets, I invest more in allies I support and withdraw if I disagree. For example, Saudi Arabia may threaten the UK. If you don't let me buy Newcastle, I'll withdraw my investments. This kind of leverage is quite substantial. The executive order outlines objectives, first promoting fiscal sustainability and reducing tax burdens on American households and small businesses. Simply put, it's about revenue generation and establishing long-term economic security, challenging U.S.'s global economic and strategic leadership. This aligns with our second and third points, but I believe the first is challenging for the U.S. Given their persistent fiscal deficit, it's hard to see how they could obtain such significant funds. They still need to ease their fiscal pressure, similar to someone deeply in debt claiming to establish a massive fund today. The fund's interest and returns could help me pay off the debt, right? Doesn't this suggest a logical loophole? The US has numerous high-quality assets and strong financing capabilities, but general market opinion is that financial returns are not the primary purpose of this fund. Even if it's difficult to achieve in the short term, its primary purpose is most likely the second point: to promote the United States' leadership in economic and strategic domains. In the current deglobalization cycle, governments like the US and UK recognize the benefits of sovereign funds, enabling direct action in international markets. It allows the government to extend its reach and grasp more precisely while operating discreetly. The TikTok incident directly exemplifies this. It caused the US much embarrassment. Trump suggested our sovereign fund could buy TikTok, avoiding court issues and needing others to help with the acquisition. Ming Pao, Canada, Toronto. When discussing the sovereign fund, good or bad, you might ask why the US federal government didn't have its own before. The reason is simple: they lacked the money. Although the US economy has grown significantly and people's wealth has increased over decades, the government itself lacks sufficient funds. By reviewing the world's top 10 sovereign wealth funds for patterns, it's clear that wealth accumulation follows two scenarios: oil-rich nations with abundant resources. To prevent resource curse from quick gains, governments create funds, enabling those with current and trade surpluses to attract foreign investment through services. Attract foreign capital through trade and investment. Thus, by establishing a fund, they continuously earn money from other countries and accumulate large amounts of dollars. However, the US, though developed with high per capita GDP, faces persistent trade and current account deficits and rising government debt. Whether viewed as the entire economy or its federal government, both are like debtors. They owe money as expected. They cannot naturally accumulate wealth to establish a fund. Since the government has no money, it's unclear where Trump plans to obtain trillions to form this sovereign group. In fact, he hasn't provided any clear solutions yet, so we can only analyze if you need to obtain money, there are only four options: either earn, borrow, sell, or print money, right? Printing money isn't an option. Although the United States can print money, doing so blatantly would likely cause the dollar's international credibility to vanish. Transferring is unlikely, as mentioned. Even if possible, it's slow. You must accumulate gradually. During Trump's election, he mentioned intending to implement tariffs. Accumulating its own sovereign fund is not very realistic in the short term, mainly because the US tariff revenue is too low or because the fund requires too much money. Excessive tariff increases and accumulating trillions for a sovereign fund would likely retire Trump. Currently, selling assets is the main revenue option. The executive order states the federal government holds assets valued at $5.7 trillion plus countless potential natural resources. U.S. Treasury Secretary Bicent mentioned the possibility of selling government assets for funding, though she didn't specify what to sell. People speculate it might involve land. selling buildings and such. Some even joke that they might sell places like Alaska or Hawaii. Financing is possible, such as government bond issuance like China did to establish the CITIC. Another financing concern is high U.S. interest rates. The 10-year Treasury yield has already exceeded 4%. Another financing method is the government directly attracting investments, such as approaching Elon Musk or firms like BlackRock. It's not impossible. After 90 days of the executive order, the U.S. will present a plan. If still interesting, everyone can analyze further. Our two-part video series explores the world's largest sovereign funds, not just out of curiosity, but to gain insights into various governments. Their operating methods, investment logic, and organizational structure play crucial roles in their ongoing success. Moreover, by viewing their investment approaches, have you gained a deeper understanding of managing your assets? Once again, thanks to Mumu for supporting this video. Check pinned comments for benefits.